We are diving into a company that just reported numbers that were, well, so compelling they're basically forced Wall Street to pay attention. Yet at the same time, they sparked this immediate debate about strategy. We're going to be dissecting the Q3 financial analysis for HIMS and HERS. That's HUP-S.
Right. And our mission today is pretty straightforward. We need to filter out that immediate headline noise and get straight to the core tension in this Q3 report.
The tension being?
Well, Wall Street analysts, they immediately focused on what the analysis calls the pennies, that minor earnings per share miss.
Okay.
But if you look deeper, we really have to focus on the dollars. And that's the massive revenue explosion and the strategic intent behind every single one of those dollars spent. This is a strong contrarian view, really, to understand what's happening, especially with this weight loss supercycle.
And that's why this is such an essential deep dive for you, the learner. We're taking a detailed financial analysis report of HIMS' Q3 performance and turning it into, actionable knowledge. We're focusing on how that high growth really intersects with their market strategy. You are going to walk away understanding the difference between that short-term noise and, well, long-term strategic dominance.
I think that's the key.
So let's start with the top line, what the analysis calls the growth monster. It's just so rare to see a company of this scale continue to, accelerate its growth rate. So tell us, what was the wow factor here?
Well, the revenue number by itself is staggering. They hit $600 million for the quarter.
That's $100 million.
$600 million. That puts them firmly into the category of a major market player. But the number that truly validates their strategy is the year-over-year growth rate, which came in at a remarkable 49%.
49%, that's not just growth, that is acceleration.
It is.
For those listening, the general expectation for a company that's reached HIMS' size is, usually a slow deceleration of growth. When you see a company like this push its rate of expansion upward, it's a really powerful signal.
It absolutely validates two things. First, that the demand for their personalized telehealth model is incredibly strong. Stronger than a lot of analysts had predicted.
Right.
And second, it proves that the total addressable market is just far larger than people thought, allowing them to capture all this share without hitting a ceiling.
Yeah.
Wall Street expected things to cool off. Instead, HIMS turned up the heat.
And it's not just money coming in the door, it's people committing to the platform. They hit a huge subscriber milestone in Q3.
A huge one.
Reaching approximately 2.5 million subscribers. That's a solid 20% year-over-year increase. And subscriptions, that's the lifeblood of these businesses, right? It's reliable recurring revenue.
This is the crucial takeaway for you right here. When you see revenue growth accelerating toward 50%, the entire strategic focus just shifts. It's no longer about hitting minor profitability targets.
It's about something big.
It's about aggressive market share capture. The analysis suggests that worrying over small earnings details is a classic mistake. It completely overlooks the company's clear, stated, and successful strategy of just devouring market share quickly and establishing dominance. They are buying future revenue by spending right now.
That sets up our next piece of the puzzle perfectly. We've established that they grew massively, but now we need to talk about what specifically ignited this expansion in Q3. The analysis points directly to one major engine.
The compounded GLP-1 strategy.
Exactly.
Yeah, and this is where the strategy gets incredibly interesting. We're talking about the weight loss boom, of course, centered around that wildly successful class of drugs like Wegovy and Ozempic.
But there was a problem there.
A massive bottleneck, widespread supply shortages for those name-brand medications.
So how did HIMS manage to turn a global supply shortage into their primary growth engine? That seems counterintuitive.
They leveraged the compounding angle. So compounding allows pharmacies to create custom formulations of drugs, often with the same active ingredients, especially when the name brand versions are unavailable because of a shortage.
Ah, okay.
So HIMS provided accessible, compounded GLP-1 alternatives, and they effectively stepped right into that massive supply gap.
Yeah.
They solved a real consumer problem and became the reliable, accessible on-ramp to this category that everyone wants to get into.
That is a brilliant tactical move. They took the market's biggest weakness, the lack of supply, and just used their infrastructure to monetize it. But here's the critical question, the skeptical question. If their growth is so reliant on these compounded alternatives, doesn't that expose them to a massive risk if the big name brand manufacturers suddenly fix their supply issues?
That is the exact question a skeptical investor should be asking.
Yep.
And the Q3 numbers, they provide the answer. This is the analysis's central insight. The strategy isn't dependent on shortages forever. It's about using weight loss as an entry point. The growth we saw in Q3 confirms the weight loss category isn't just hype. It's a powerful way to bring in new, highly motivated subscribers.
So it's a very successful marketing funnel that's kind of disguised as a medical service.
Exactly. They are building what the analysis calls a sticky ecosystem. Think of it like this. A customer comes in specifically looking for the weight loss solution,
Yeah.
but once they're on the platform, once they trust the process, the doctors, the convenience, they're highly likely to expand their subscriptions to other services.
I see the pattern now. So you might start with the compounded GLP-1s, but then you realize you can also get high-quality treatment for anxiety or dermatology or hair loss all through the same convenient app.
That is the key metric they are measuring. And the analysis shows that dermatology, mental health, hair growth, they're all benefiting from this weight loss influx. This transition suggests HIMS is evolving, and rapidly, from just a simple, single-service telehealth app into what we should really consider a true consumer health giant.
A consumer health giant.
They're not just selling solutions anymore. They're selling a holistic, multi-service subscription platform.
Okay, we absolutely have to address the contrarian view now. The piece of the Q3 report that caused that initial market hesitation. Let's talk about the dreaded earnings per share miss. This is the bad news the bears jumped on.
Yes, the earnings miss. This is the pennies part of our framework. The company reported an EPS of 6 cents, which fell short of the expected consensus of 10 cents.
10 cents, okay.
That 4-cent gap is what generated all the negative headlines.
So for you, the listener, trying to reconcile 49% revenue growth with an EPS miss, what's the strategic argument we need to understand here?
This is where we apply that strategic reframing. The miss wasn't a sign of poor operations or, weakening demand. It was the opposite, in fact. The company spent heavily on marketing, on infrastructure, on expanding their clinical capabilities precisely to acquire those 2.5 million subscribers and to achieve that nearly 50% growth rate.
So it was a choice, a calculated choice.
A very calculated choice. They intentionally sacrificed some short-term profitability to fund that long-term market dominance.
So if you're assessing a high-growth company in what you called its land grab phase.
Precisely. You have to prioritize growth metrics revenue, subscriber acceleration over EPS. The analysis argues that if HIMS had chosen to hit that 10-cent EPS target, they would have had to slow down their spending, and that means they would have missed out on capturing hundreds of thousands of new users during this explosive weight loss supercycle.
That does raise a fair question, though. When does that trade-off stop making sense? When is the right time to pull back on the spending and prove they can be truly profitable?
And the answer is, the time is not yet. The analysis suggests the market is still wide open. When you see a company growing revenue at nearly 50%, the goal remains the same. Push the accelerator to the floor until you have the dominant position. The heavy investment is just the cost of doing business to capture that market share.
So punishing them for it is short-sighted.
In this strategic context, yes, it's short-sighted.
And speaking of people betting against the company, the report highlighted a huge potential dynamic here. The short squeeze risk. The short interest is high, around 34%.
Yeah, that level of short interest is a massive overhang for the stock, but it turns into a huge liability for the bears when the company delivers acceleration like this. Strong revenue growth, especially 49% year over year, acts as the ultimate bear trap.
A bear trap.
As the narrative solidifies and the price starts to climb, those short sellers are forced to buy back shares to cover their positions, which creates this tremendous wave of buying pressure that just accelerates the stock upward. The growth monster effectively eats the short sellers.
Okay, let's get into the market's reaction then. The technical signals. The analysis noted the stock was trading around $34.67 post-earnings. What did the actual buying action tell us?
This is crucial. The technical analysis saw that the stock, it dipped immediately at the open as the market was digesting that EPS miss. But buyers stepped in very quickly and very aggressively.
Oh, interesting.
They held a key technical support level at $34.13. That immediate, decisive buying the dip behavior is a highly bullish signal. It indicates that the institutional money, the smart money, is looking past the headline and buying into the long-term growth story.
And yet, despite that strength, the valuation perspective in the analysis suggests there's a major disconnect. Can you describe this coiled spring analogy for us?
Absolutely. So right now, the stock is trading in the lower half of its 52-week range, which goes from about $23 up to $72.
Wow, that's a wide range.
It is. So think about that dynamic for a second. You have a company that is accelerating its growth rate to 49%, successfully becoming a consumer health giant, and it's trading closer to its yearly low than its high.
Yeah, that doesn't really make logical sense based on the metrics you just laid out.
It creates compression. The analysis describes this price squeeze as a coiled spring. The market hasn't fully priced in the accelerating growth yet because of that initial panic around the EPS miss. All that positive fundamental energy, the growth, the subscribers, it's being suppressed by short-term sentiment. Once that spring is released, the price movement could be dramatic.
So what are the professionals expecting? What are the price targets looking like?
Well, management itself raised their full-year outlook, which is probably the most bullish signal a company can give. And looking at the analyst consensus after Q3, the average target price for the stock is around $46.
46. So that implies, what, about a 32% upside from where it is now?
An implied upside of about 32%? Yeah.
This is fascinating. The analysis is suggesting the street remains pretty cautious, with many hold ratings, but their actual price targets tell a completely different story. They're basically saying the stock is fundamentally undervalued right here, right now.
Precisely. That specific disconnect, the difference between the cautious sentiment and the aggressive price target, that is where the opportunity lies for the learner who understands the strategic dominance play. The market is waiting for confirmation, but the numbers, well, they already provided the answer.
So to synthesize everything we've covered, the essential finding from the HIMS Q3 report is that this weight loss segment, which was enabled by their compounding strategy, is a powerful long-term subscriber engine. This growth explosion, the dollars, it fully justifies the heavy calculated spending, the pennies of the EPS miss that's required to dominate the market.
And here's the final provocative thought for you to explore as you digest all this. The analysis highlights a very clear short-term tactical point. If HIMS can confidently hold that critical 34.50 level, and the Q3 reaction suggests there's strong support there, the next short-term target is $40.
$40.
But the key question for you to really consider is whether this focus on market share now will truly pay off over the next decade. The analysis strongly suggests that the current trading range, being near the low end of that yearly range, might be the gift the market is offering.
A gift.
A gift. Provided, of course, you believe in the long-term vision of this company evolving into a full-fledged consumer health giant. It's something to chew on as you connect those dollars to those strategic pennies.